You check your bank balance, see your money sitting there, and feel like it's safe. But here's something most people never stop to think about. Your money can actually be losing value every single month, even while the number on the screen stays exactly the same. And it's completely legal. Your bank isn't doing anything wrong. It's just playing a system that works in its favor, not yours. If you're in the US or the UK, this is worth 10 minutes of your time. Because once you understand how this works, you'll never look at your bank balance the same way again. Most of us were raised the same way when it comes to money. Get a job, open a savings account, put your paycheck in, don't touch it. That's being responsible. That's what felt safe. And in one sense, it is safe. Your money isn't going to disappear. In the US, it's insured up to $250,000 through the FDIC. In the UK, up to £85,000 through the FSCS. But here's the distinction almost nobody makes. Safe from loss is not the same as safe from erosion. Let's put real numbers on this. Say you have $10,000 in a traditional savings account paying 0.05% interest, close to the national average at most big banks. After a full year, you've earned about $5. Not $500. $5. Now compare that to inflation. At around 3% a year, that same $10,000 has lost about $300 in real purchasing power. So on paper you have $10,005. In reality, what that money can buy has dropped by close to $295. A cart of groceries that cost $100 last year now costs $103. And if your savings barely moved, you quietly fell behind, without a single transaction ever showing up as a loss. So where does the money go instead? It's not a conspiracy, it's just how banking works. When you deposit money, you're lending it to the bank. They pay you a tiny amount of interest, then lend that same money out to other people through mortgages, car loans, and credit cards. Often at 6%, 7%, sometimes 20% plus. So your bank takes your $10,000, pays you $5 a year for it, then lends a chunk of that same money out at 7%. That gap is the entire business model. Borrow cheap from depositors, lend expensive to borrowers. It's not evil, it's just a system most people never question, assuming the rate they're given is simply what a bank pays. Very few people with meaningful savings leave large sums sitting in a 0.05% account long-term. Often it's much simpler than investing in stocks. They're just using higher yield, equally safe alternatives most people don't know exist. In the US, high-yield savings accounts, or HYSAs, are still FDIC insured and fully liquid. But instead of 0.05%, many currently pay 4% to 5%. On that same $10,000, that's the difference between earning $5 a year and $400 to $500 a year. Same safety, same access, very different outcome. In the UK, the equivalent is often a cash ISA or stocks and shares ISA. Say you put £10,000 into a stocks and shares ISA and it grows 7% in a year. That's £700, and because it's inside an ISA, it's completely tax-free. Outside an ISA, part of that gain could be taxed depending on your allowances. Over 10 or 20 years, that tax-free compounding adds up. Over time, keep $10,000 in a traditional account at 0.05% for 10 years, and you'd end up with roughly $10,050. About $50 earned in an entire decade. Put that same $10,000 in an HYSA averaging 4% over 10 years, and you'd have around $14,800. A difference of nearly $4,750 just from choosing a different account. Go one step further into investing. Say a broad index fund averaging 7 to 8% a year, and that $10,000 could grow to $19,000 to $21,000 over the same 10 years. Roughly double, just by staying invested. The real damage usually isn't from picking the wrong investment. It's from leaving money sitting somewhere earning next to nothing for years. How to actually fix this? Step 1. Open your banking app right now and check your savings rate. If it starts with a 0 before the decimal point, it's not working for you. Step 2. Keep your emergency fund liquid and safe, but move it somewhere better. A reputable FDIC-insured HYSA in the US, or a cash ISA in the UK. Step 3. Think beyond saving. Low-cost, diversified index funds are a common starting point for growing money faster than inflation, without needing expert-level knowledge. Step 4. Automate a monthly transfer into that better account, so the decision only has to be made once. None of this needs a financial advisor or a large starting sum. Just the awareness you now have. Nobody is more invested in your financial future than you are. This isn't about banks being evil. It's about understanding how the rules work, so they benefit you instead of quietly working against you. If this helped you see your savings differently, hit like and subscribe to Money Decoded for more breakdowns like this. Drop a comment. What interest rate is your bank actually paying you right now? Thanks for watching, and I'll see you in the next one.